When I was talking bearish on Bitcoin at 65, I hope at least in the very least, I save some people some heartache and some hardships by hopefully making them be a little bit more conservative. So that's the key, is that, there's always a trade, but you want to be conservative when the Fed is telling you to be conservative when they're hiking rates. The Federal Reserve went from a body that was printing. The government was printing. And all of a sudden, we're not getting any new stimulus, no new kind of build back better plans in the government. That's not going to pass. And the Federal Reserve reducing their balance sheet, raising interest rates, stopping QE. And it's basically putting a hard ceiling on the market. The market has no place to go but down to kind of unwind what we've been seeing. So this is kind of why in December when we talked, I talked about how gold would be the best performer in 2022. And so far it has been as we approach getting closer to the midpoint in the year. But bottom line is this market will have major bounces. The great thing about a market that's not backstopped by the Fed is that there's volatility. So for swing traders and day traders, this is the best market in the world. For investors who are long-term, it's going to be a tough market. There's a lot more downside to go. I've been warning people to be more cautious, to be more conservative, be more of a trader if you're a trader, otherwise sit on the sidelines or get into something like gold. And I think that's important to understand, folks, is that people always said, don't fight the Fed on the way up, right? Because the Fed was printing money. Yet for some reason, people are fighting the Fed now when they're doing the opposite, and they shouldn't be. So think about that. It's very, very logical. Don't use emotion. You're seeing stocks that are discounted heavily. They're going to get cheaper. Apple's going to go down. Amazon probably goes to 2,000 before it gets a level to buy. So be ready for that. The Fed has been amazing at just telling the market and reiterating again what they're going to do. So we're going to get a 50 basis point hike. The key is going to be this, right? And this is what the market's looking at. And by the way, we're getting a pause day today in the markets. You'll probably get that again tomorrow because everyone's just waiting for this. And the statement is what's going to make the difference. So what I've been saying to people is from a 1 to 10, the Fed has been talking up the rate hikes and what they're going to do at a 10. They're at the most hawkish that they've been in a long time, if ever. The question is if the market continues to sell or the economy, and we saw GDP last week come in very, very weak, can they come out at a 9 or an 8? So we're still talking hawkish. The Fed's not going dovish. People need to forget about that. But it's the degree of hawkishness that's going to determine where the markets go Wednesday and after Wednesday. And they basically said, hey, listen, no matter what the economy does, no matter what the stock market does, we are going to continue to rip rates higher 8 times this year or so. That would freak the markets out. Because again, what the market's concerned about here is that the Fed is slowing the economy. The supply side of things is causing price inflation, which is slowing the economy. Oil prices are high, that's slowing the economy. And the market wants to know that if the economy slows substantially, the Fed will back off a little bit. So if the Fed does not say anything like that, that will scare the markets. If the Fed gives us just that inkling, that little tiny crack in the wall that says, hey, listen, we would potentially back off from 8 rate hikes to 4 or 6 or 5, that would be something that the market would say, all right, the Fed is still around. They're still here to help us just in case. Yes, they have to fight inflation, which is important, but they're not totally leaving us for good. The stock market is still way above the pre-COVID highs. The inflation issues are just we're just not seeing inflation coming down right now in any metric. And that is going to make the Fed probably be very, very hawkish and continue to be hawkish if they can give just a small if they can throw a bone to the market, if you will, by saying, hey, listen, don't worry, guys. If it gets too crazy, if the economy goes into a steep recession, we will back off. Then the markets start to rally and tech could rally. And by the way, the 10-year is bubbling up against 3% today. I do think you are going to get a pullback off this 3% level. In fact, I've been buying the TLT, which is kind of an inverse play where if rates come back down a little bit in a short-term trade, and this is only a swing trade, TLT would bounce. So I've been accumulating the TLT. This is really potentially going to be one of the nastiest storms we have seen in the market, where again, I think that again, you're looking at the NASDAQ potentially being down 40 to 50% over the next 12 months from the highs of last year. I think right now we're down about 22, 23%. Right. So I think you go down about 40 to 50% at least within the next 12 months. So it is not going to be a pretty thing. And you're already seeing the cracks, right? I mean, we've seen Facebook collapse. We've seen Netflix collapse. Apple's still holding on, but notice how Apple's earnings were amazing amazing, and the stock is still selling off. Notice how Tesla's earnings were amazing, and Tesla still ended up selling off after that initial pop on earnings. Those are the signs that tell you big money is exiting from these big names, and it's just the start. And because those names make up such massive percentages of the indexes, that alone can take down the markets. I mean, you could have some of these beaten down plays that are down 90%, hold steady even, probably go down a little, but just those big cap names can take the NASDAQ 100 down another 20%. Yeah. So again, bottom line is this is all stems from monetary policy and government overreach in terms of spending. And listen, I'm all for doing certain types of spending where you help people, but it's gotten to the point where there's way too much kind of fluff in every single deal, and you got to cut it out and go right to the source. So again, this is where Bitcoin comes in, and the future of why I believe in Bitcoin, even though I'm a near-term bear, meaning that I think it's going to go lower. But yeah, I mean, it's absolutely the Federal Reserve that's at the core of this. There are ways to do it. The Fed now is caught between a rock and a hard place, which is in their own doing, which is they've created this scenario where you have massive inflation, and then you have these kind of effects like these black swans where Russia invades or China is now shutting down these cities, and it causes more of an inflationary pressure. But the pressure was already there because of what the Federal Reserve was doing, and it's inevitable that you're going to have these black swan events that at some point are going to bubble up, and it wouldn't be as big of a deal if you didn't have all the monetary easing that caused the initial inflation surge. So it's just, I mean, you have to let the free market be the free market. The problem is, I mean, we think that we live in a free market society, but honestly, we haven't. As long as the Fed had that dual mandate where they've been forced to focus on unemployment back from 1977, it's never been a fully free market. And I do believe that if you had a fully free market, things would be working a lot more smoothly. Heard about, Russia maybe cutting off the pipelines of natural gas to Poland and some other countries. And the bottom line is the oil charts and the natural gas charts didn't even make higher highs in the near term. Here's your high on oil, lower high, and basically lower high. That is not a bullish sign. It shows you smart money is moving away. Now, if we look at the natural gas chart here, the same thing is going on, right? So basically, you got those headlines, and look at how this high, which was about 2 to 3 weeks ago, even with the headlines recently about natural gas, you're not seeing natural gas make a new high. Now, part of that probably is that we're warming up. The world, again, Europe is starting to warm up. But again, when you see lower highs on more aggressive headlines where the price should actually be making a higher high, that's telling you smart money is starting to unload. And the bottom line is the reason why I don't believe that oil and natural gas are going to make higher highs is because now the global economy, and people are starting to realize this, the global economy is starting to slow due to high oil, due to high inflation, due to Federal Reserve and global central banks hiking rates. And that, again, is going to hurt the demand side, which will keep prices from making new highs. I'm not short oil right now. I am short natural gas. Silver, I have been accumulating silver on the long side in this lower range here. We've now come back in to basically retest the breakout. You have this upsloping trend line kind of coming right into here. Look at all these red candles on silver. So silver is primed for a bounce. What I love about silver today is that early in the day it was down sharply, and it's now coming back not too far from the flat line. So again, way oversold near term, right back to what I would call the retrace where we were consolidating here. I think silver is going to start to take off. And gold, I think the last time we talked, I said I was waiting to buy gold till it got back to about 1850 on spot gold. Well, if we take a look at gold today, it finally did dip. The low today was right around 1850. It's now in my buy range, right in this 1850 to 1825 range. And these are the retraces that as a metals investor that I've been waiting for. So again, I am in silver. I haven't picked up any gold yet, but I'm looking to buy gold if it dips just a little bit more as well. I've never missed a trade and said, oh man, that was the last trade I ever got in my entire life. So if you miss a level, you find your level, you're disciplined enough to stick at your level. If it gets filled, it gets filled. If not, you say, okay, well, there'll be something to trade tomorrow instead. So in general, levels will hit, but occasionally they do miss by a hair. And that's just the nature of the buying volume that comes in. So yeah, it's always possible. Ultimately, I think gold is going to go way, way higher. I'm talking more on a swing trade. Now, to be clear, I do own a lot of physical gold and a lot of physical silver. I always hold that. I'm not trading that because it's physical. There's too much cost to trading it. But again, when we're talking about a swing trade on gold, I'm looking at this area, 1850 to 1825. I think within the next 6 weeks, we probably do trade back up to 2070, which was that previous high. I think by end of year, you could be looking at 24 to 2,500 on gold. On silver, the big level to watch is basically back to this high here, which was the Wall Street bets pump here and the previous high. So you're looking around 30. And I think by end of year, you have a decent shot of getting back to 30 or maybe just in early 2023. This is your buy range right here, which is what we call a retrace to the scene of the crime, a retrace to the breakout. So you had a gold breakout. It's now got it should retrace into this 1850, 1825 level. If by chance it starts to break lower and it comes down here, I would want to see it hold this 1800 level. Trades below 1800, then you have the potential of going down maybe as low as 1680 or so. So again, this is becoming a huge level. I do expect it to hold. And again, if you just think logically with inflation, with the concerns about the global economy, where are people going to hide when they're de-risking? It's generally going to be the metals and mainly gold. But again, always a chance you could be wrong. So understand what levels it needs to hold and where it could go if it breaks. Referred to as a bear flag. And what's interesting is you can see the opposite thing right over here, where you actually remember back last year, you actually were making the opposite pattern and look at the direction it went. So when you're angling down, it's making investors feel more insecure, making investors feel more bearish, and therefore price is going to go the opposite of retail investors and going to go up usually. When you go this way, this is luring investors in. They're trying to con you in, not con literally, but it's trying to fake you out in terms of the price action. And this one breaks down. So again, people are saying, well, isn't this the same as this? And the answer is no, it's not. This was a down sloping channel. It breaks up. Upsloping channels tend to break down. So just to be clear, I mean, when you're talking about trading the range, so short, long, I mean, that's where you get into these really tight levels. But if we're talking medium term, let's talk 6, 12 months out when I think Bitcoin has a good shot of bottoming out. I mean, we're talking about some major downside. I'm still in the camp that you're likely headed to 20,000 or below as an ultimate target. Again, 20,000 would be the 2017 high. I think you're seeing more and more the realization that the stock market is weakening and money's being pulled out. It's a de-risking going on, which is very bad for Bitcoin since Bitcoin trades off of the NASDAQ essentially with de-risking. Yeah. And you have to see this washout. I've said this from day one, going back to, our in-person interview in Dubai last October, that you have to see this full washout. You almost have 20,000 cryptocurrencies. There should only be like 20. And so you have to see this .com type flush out where a lot of these go away. And then ultimately from the dust will rise the best of breed, very Darwinian in that, and they will succeed and they will flourish, and Bitcoin will see 500,000 and we'll see $1 million. So ultimately midterms, next 6 to 12 months, 20,000 at minimum, maybe lower. But again, that is my midterms 12 month target. For Bitcoin, 6 to 12, hard to pinpoint. I'm using past cycles. It took 12 to 18 months for Bitcoin to bottom out in previous cycles. We're already 6 months in from the high, so 6 to 12. Yeah. When I was talking bearish on Bitcoin at 65, I hope at least in the very least I save some people some heartache and some hardships by hopefully making them be a little bit more conservative. So that's the key, is that there's always a trade, but you want to be conservative when the Fed is telling you to be conservative when they're hiking rates.